there's always a market for diet versions of things. It may not be you and me, but it's from the asset manager's perspective. They just broaden their reach. So
all right, joining me will be Aniket Ullal, head of ETF Research and Analytics at CFRA, who's one of the world's leading independent investment research firms. And Aniket is someone who covers the ETF space as well and as closely as anyone anywhere. He's always one of my favorite people to visit with. We have a fun topic for you this week. So we're going to look at ETF trades that have and have not worked so far this year. Aniket has provided me with several categories of ETF trades that have caught his attention, whether for good or bad reasons. And we're going to walk through those in pretty good detail. Aniket will explain what's gone right and what's gone wrong here. And then we'll also spend a few minutes looking ahead to the remainder of the year and even into 2026. Aniket will offer up an ETF category or two he's keeping an eye on moving forward. Now, to start this week, I'll be joined by Cinthia Murphy, investment strategist at VettaFi. And longtime listeners know that one of my favorite things to do on here is talk about new ETF launches. And I will tell you, there have been a boatload recently. We've seen a record pace of ETF launches. It seems like every month is setting another record. But I went through the launches over about the past 3 or 4 weeks, and I have picked out 6 that I want to get Cynthia's hot take on. So that should be fun as well. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. All right, so let me now welcome in VettaFi's Cinthia Murphy. Cinthia, as I was saying, I seriously can keep up with these ETF launches anymore. I was checking this morning. There have been about 100 new ETFs just in October. And it's funny because I'll start looking at the list of new launches and I'll be like, I had no idea that American Century launched the small cap value ETF or whatever. There are just so many ETFs coming to market. But I know, like I feel like, I know you're the same way. That's what makes this all very fun, right?
absolutely, it's just when you think you can't get any more new ETFs, we get more. I think to your point, 100 in October, and October's not even over yet. I think we've been basically hitting about 100 new launches a month. So we are breaking every record in the book, and it's not even ETF share class season yet. So it's just going to get crazier before it gets calmer, I think.
Well, so like I said, I looked back over, I think it was about the past month or so, and I have picked out 6 ETFs that caught my attention. And so I thought, I'm just going to tee these up. You can offer your hot take, and we'll see where that takes us, which could be anywhere. And I'm going to jump right in. The first ETF I have is probably one that a lot of people have heard about just because the mainstream media really ran with this launch. I saw it everywhere. Bloomberg, CNBC, it seems like everybody covered this. And that's the Roundhill Meme Stock ETF, ticker meme, great ticker, which interestingly, this is a reincarnation, right? This ETF first launched back in 2021. It then closed, I think, in 2023. It's now been brought back to life. And very simply, this is an active ETF that seeks to offer targeted exposure to meme stock. So what do you think about this one?
So I think it's interesting that we've tried this before. It didn't work. And here we are again. So to your point, this launched in, I think, 21, lasted a couple of years. It shut down with no assets. Nobody cared for it. And now here we are. It relaunched, I think it was this month, and it's already at $30 million or so in assets. So the old is new again. And it's interesting, if nothing else, it says something about the times we're living in. So we keep talking about market concern. We keep talking about needing to diversify. And here a meme stock ETF is back to life and is doing well. And this is a strategy. It really is. It's all about implied volatility. So it picks 13 to 25 names. It looks for the highest implied volatility names. It looks for, and then it kind of weights based on volatility. One of the screens here is social media momentum. So this really is, by definition, a meme stock ETF. And so you find really interesting names in there, and like Open Door, Krispy Kreme, Beyond Meat, I think is the biggest holding in there right now. And here we are. It's we're back to meme stocks. Who knew we would get back here? But here we are in the same year where gold is making records. Uh, protection and safe haven is making records. Here we are, meme stocking it. So let's go.
So, do you think this will have a better chance at success than the first time around? And it's interesting. I think Roundhill is really positioning this as the rise of the retail investor, right? Just that the retail investor now has a much bigger footprint in the markets, and maybe they can influence stock prices a little bit more. And we did see this obviously again back when they first launched. But I think if you look at all of the different ETFs that are coming to market now, we're talking about new launches, a lot of them are really much more geared towards the retail investor. At least I think so when you think about leveraged single stock ETFs and some of the yield plays. So I guess my question is, do you think because the retail investor, that footprint has grown bigger since meme last was on the market, that maybe they have a better shot at success? Because this is clearly geared towards the retail investor.
100%. I can't imagine advisors suggesting clients put this anywhere. It could happen. I mean, we've seen crazier things happen. But I do think, Nate, to the point of retail, I think just industry wide among the asset managers, product providers, there's this realization that retail investors are a force. I think for so many years, we focused so much on all the monies in the advisory channel and all the products are geared to the advisors. And all of a sudden, you talk to all these big asset managers, everybody's trying to find that path direct to retail because they've proven that they have money, they're willing to put it in the market. I think this is a post-COVID phenomenon, when folks all of a sudden had stimulus checks in their pockets. I think a lot of folks started investing in a way that they hadn't before. And that trend is just here to stay. So it could actually work this time around. But we'll see. I think it's also very dependent on the market. I think if we really get a market that turns negative for a while, I think appetite for this kind of play dries out a little bit, but maybe not. It's really interesting.
No, I think to your last point, I agree. I think that ultimately this will come down to performance, and this is clearly a high beta risk on play. And so if the markets are screaming ahead and this is outperforming, it's going to find an audience. But if we have a sharp downturn, clearly that's going to be a challenge for this ETF. Okay, so the next ETF I selected, it's one I'm actually surprised didn't get more mainstream media attention, and that's the Defiance $1 Trillion Club Index ETF, ticker TRIL, TRIL. So this holds companies, and I have to point out, crypto assets with a market cap above $1 trillion. And so if you look at holdings right now, we're talking about Tesla, NVIDIA, Alphabet, Apple, Microsoft, Broadcom, Meta, Berkshire, Amazon, and iBit, the iShares Bitcoin Trust. So it's sort of like a Mag 7 Plus ETF, I guess is the way that I would look at this. I thought this was creative, especially with the crypto twist. But what did you think about this one?
Yeah, I think it's interesting from the perspective that, again, and you and I think, sit on the same side of this conversation about diversification is so important. Beware of market concentration. And this is the opposite of that. It's like, just go all in on the biggest companies out there. This is a really small portfolio. It's basically the Mag 7 plus two companies and in a crypto ETF. So it's very concentrated. I mean, it tries to manage that. I think it equally weights the companies. It rebalances monthly. So it's trying to, at least be equal among the few holdings he has in there. But it's interesting because it says to me that, for all of the talk about watch out for concentration, diversify, the appetite for the leaders continues to be strong. And we've seen that too, Nate, and you and I have talked about this before on the S&P 500, different type of S&P 500 ETFs. We're seeing almost a reinvention of that space too, with things like the Pure Cap ETFs from Global X. Rafi just came out with a different way to rejigger, S&P 500 stocks. So I think there's this appetite for, hey, let's be safe and diversify long term, but there's also this appetite for how do you own the top companies in a way that makes sense. And this is one of those ways. So it's an interesting ETF. It's not too cheap. I think it's 49 basis points. So for this portfolio, maybe that's a deterrent of why I didn't get more attention. I'm not sure, but it's a sign of the times.
It is. I think your take was exactly the same as mine. This is basically you just throwing up your hands and going, you know what, I'm going all in on Mag 7 or Mag 7 Plus. That's what's driving the market. I'm going to keep riding the momentum. It's interesting. I don't know if you saw our friend Todd Sohn over at Strategist. He had a really interesting chart last week where he showed ETF exposure to 1 trillion market cap companies. So in other words, he was looking at the NVIDIAs of the world and the Microsofts of the world and saying, okay, how many ETFs actually own those stocks? And so to give you an example, there are 685 ETFs that own NVIDIA, and the average weight is 6.5%. Or if you want to look at, say, Microsoft, 687 ETFs own Microsoft with an average weight of 5.6%. His point was like, a lot of ETFs out there already have this exposure. And so to exactly what you're saying, if you're going to allocate here, you probably already have a lot of exposure. And so you're just doubling down. And so, I think it's interesting. You can tell even just with these first 2 ETFs we cover, I always like to think about what the audience for this will look like. And I think that's what it is. It's somebody who just says, you know what, I'm going all in on Mag 7, and I'm going to keep riding that train and hope that it works out. But we'll see. I think it's a very creative idea, but the point here is that a lot of investors already have exposure to these stocks, right?
Yeah, I think it's in some ways, like the meme stock ETF. Maybe it's this like little side of hot sauce, to quote our friend, or the little jar on the side you're going to sprinkle your equity allocation with this kind of high octane for a little bit extra here and there. But that also means if that's the use here, then this is a position that's going to come and go for portfolios, may not be a perennial type of allocation, more tactical. So we'll see how folks find room for this.
Yeah, and again, it does have that crypto twist in it, which I think is a little bit unique. Obviously, you're not getting that exposure directly if you're, allocating to something that owns the Mag 7. So, to your point, a little hot sauce that you can sprinkle on your portfolio. Okay, the next ETF I want to ask you about is one that I think we actually discussed back in July when ARK first filed for the suite. And the first ETF that rolled out as part of that suite is called the ARK Diet Q4 Buffer ETF. The ticker is ARKT. And this is part of what they're calling the Defined Innovation Exposure Term ETF suite. So that Defined Innovation Exposure Term, that stands, or the acronym for that is DIET, obviously. And let me try to explain this. So this ETF offers exposure to the ARK Innovation ETF, ticker ARKK, but you have less downside participation over the full 12-month outcome period. And then after a 5% hurdle, you participate in approximately 50 to 80% of the upside. It depends on the market conditions when these ETFs are first set up. And I actually misunderstood these when the filings first came out because we discussed this. You can go back and listen. I don't think I had this right. So my understanding of what ARK is doing is if you buy ARKT on day one and you hold it for the entire 12-month period, if ARKK, the ARK Innovation ETF, is down 10%, then this Diet ETF would only be down 5%, right? So you have 50% less downside participation. If ARKK is up, then you get a lot of that upside, except for that first 5% hurdle that you have to clear. So I think I'm describing this correctly now. Is that your understanding of how these work?
Yeah, 100%. I think I'm with you. I was on that conversation and I misunderstood it too. So it basically is, you're protected 50% on the downside. So down if the benchmark asset is ARKK, the ticker, which is ARK's flagship fund, the big disruptive innovation fund the one that really put Kathy Wood on the map and the firm. And so, but it's a fund, as we know, Nate, it saw massive flows, massive performance, and then completely fell out of favor. It never really recovered its heyday. And what I think is really smart about this here is a realization that this is still a really important exposure if you are a growth investor, if you believe in disruption as a path to future growth. But this is a way of bubble wrapping that exposure, which is also something we see a lot. We're obsessed with buffer. We're going to talk about more buffer ETFs in a minute. So buffering things is what we do now. And so I think this is really clever from ARK to figure out a way to buffer its own flagship fund to see if this could actually ignite a lot of new interest in it. So if ARKT, which it has, is very volatile, we've seen that performance over the years. If that thing is down 20%, you're only down 10. If it's down 30%, you're only down 15. So you're save 50% of that downside. On the upside, that first 5% upside gain, you get nothing. So if ARKT is up 5, you're up 0. If it's up 4, you're up 0. And then beyond 5% gain, you're only capturing, I think on their website, I was reading it yesterday, it's about a 63, 64% upside capture above that 5%. So again, anytime you put the options in the portfolio, you're giving up some upside participation. So you give some of that up, but it's a really interesting, I think it's a compelling case for growth investors who got burned, who are nervous, but they don't want to really give up on it. So I think it's really clever. I like this fund.
Yeah, I think you probably remember that my initial take on these was that if you truly have conviction in ARK's investment approach, why would you not want the full experience, right? But I think I'm coming around on this. So in the press release for these ETFs, I don't know if you saw this, ARK directly addressed sort of what I was saying. And they said, look, ARKK, and this is actually in the press release, they said ARKK is like Coca-Cola and these buffer ETFs are like Diet Coke. So their point was these are for different audiences and people can decide what they want. I think I still come back. I'm all for that. That makes sense to me. I'm just still of the belief that there are some things you don't want the diet version of. Like I'm not eating diet donuts or whatever. Give me the real thing. I know the risks. I just want a real donut. I think I feel the same way about, ARKK, but I get it. And you can look into the buffer ETF space or the defined outcome ETF space. Clearly, there are a lot of investors that want exposure to markets, but they want those guardrails. And so, it doesn't matter what I think, that the bottom line is the ETF market has shown that there's an audience for these products. I just feel like we were talking about hot sauce with the TRIL ETF. If you want to sprinkle ARKK in your portfolio, do it. You want the hot sauce. This would be like taking hot sauce and mixing it with water. I don't know.
Yeah, I mean, I can't argue with that, but I think what's smart here is exactly that. You're reaching a new audience for this. I mean, Coca-Cola is selling probably more Diet Coke than actual Coke. I'm not sure, but there's always a market for diet versions of things. It may not be you and me, but it's from the asset manager's perspective. They just broaden their reach, so it's interesting. We'll see. I don't know that if it's gathering a lot of assets or anything, but it would be interesting to watch.
Yeah, and how do you think about this? If let's say ARKK is having an absolutely amazing year, and you're in the diet ETF, you go, well, that I really would like that performance, but I'm not getting quite as much. I don't know. I just things always look better until you're actually in the moment. But maybe if things are down, then you feel a little bit better. Though I don't think investors ever feel great when their holdings are down. Okay, you mentioned some other buffer ETFs. I think we do have to mention these new ETFs that Aptus just launched, which I would say these are pretty plain vanilla buffer ETFs. They offer a 15% downside buffer, and then you have the usual upside cap. The difference with these ETFs is that they're only 25 basis points, which I was looking, and you can correct me if I'm wrong, I believe that makes them the lowest cost buffer ETFs on the market. Now, there are some buffer fund of funds ETFs, which are cheaper, but if you look through to the total expense ratios, obviously they're much higher because they hold other buffer ETFs. And I feel like in this category overall, naysayers have really pointed to the fees. And I may have been in the camp of a naysayer where I'm saying, okay, why don't you just control your risk by allocating to a low cost portfolio of stocks and bonds? And if you can't fully stomach a downside move, you should control that risk on the fixed income side of your portfolio. You can do it again with low cost index based ETFs. But as we were talking about with the diet ARK ETF, some people want guardrails in the market. And naysayers have pointed to the defined outcome ETF fees as being an impediment here, because you'll commonly see expense ratios north of 50 basis points or whatever, a lot of 70, 80 basis points. But it seems like Aptus is really trying to go for the jugular here. What do you think about that?
Yeah, I mean, we know that fees, at the end of the day, fees are the only thing you can control as an investor. The more you spend, the less you keep. So I think, to me, the simple takeaway here is that sometimes we get so consumed with the idea of what's innovation in product development, what's new, how do you find new white space? Sometimes innovation is just lowering the fee, and it can be very impactful innovation. So I think this is that. I mean, we have so many different flavors of buffers today in the market, and it's a space that just keeps growing dramatically. Aptos just brought something that's is not necessarily new and novel, is just cheaper, and that can be just as compelling, if not more compelling, than some other innovation out there.
Yeah, and I give them a lot of credit for trying this. I mean, Aptus has had a lot of success with their options-based strategies, and it's really been a successful ETF firm. I think an under-the-radar success. I don't think people realize some of the products they have out there. But this is interesting because they're getting into a market that you do have some larger players in. I mean, you have BlackRock involved in the buffer ETF category. It's not often that you'll see a smaller independent issuer come in and undercut the BlackRocks of the world in the category. So we'll see if investors respond there. Okay, two more ETF launches I want to ask you about. And actually, this first one is a suite of ETFs, and it comes from Pictet, who's a new entrant into the ETF space. And this is a firm, they've been around, Cinthia, 220 years. They're based in Geneva, Switzerland. And we're also talking about a firm with over $800 billion in assets. This is a big shop. But they just launched their first three ETFs in the US. So there's the Pictet AI Enhanced International Equity ETF, ticker PQNT. You have the Pictet Cleaner Planet ETF, ticker PCLN. And then the Pictet AI and Automation ETF, ticker PBOT, PBOT. And these are all actively managed. I guess the question I'll ask you is just any thoughts on somebody like Pictet getting involved in ETFs. You can talk about the ETFs themselves if you want, but I'm just thinking, bigger picture. This is interesting.
Yeah. So as far as the ETFs, great ETFs. I guess what's unique here, they do a lot of AI kind of quant tools and thematic screens. So they're interesting strategies. But I think bigger picture is we are a US market, and we think so much from the perspective of US to abroad. So US issuers going abroad, we're starting to see a wave of abroad issuers coming in. And that movement has been kind of interesting. So you have Pictet, who just came in from Geneva based. We have Man Group, London based, also just came in. We have big firms looking to the US market because it's been growing so rapidly here. So I think this is kind of an exciting, it's to see these big new players with, to your point, huge, long histories, all 200 plus years of experience in asset management, bring in their flavor of their methodology, their investment philosophy to the US market. So it's, again, just a testament to how we keep growing, how robust we are, and how there's room for more.
Do you think some of those brands will be able to translate into the ETF market? Because Pictet, again, huge shop, but I'm not sure everyone in the US is necessarily familiar with them. Can that translate? Because we know how competitive the ETF space is. And I think about financial advisors, for example. There are some legacy shops out there. You think of the Capital Groups of the world, where they came in late to the ETF space, but that brand recognition is just so strong, and they have the distribution and everything else built out. Do you see that as a challenge for somebody like Pictet?
100%. I think brand is it's definitely a hurdle, but is it a real different hurdle than if you are, an original ETF shop? We have a lot of ETF small issuers that are brand new to the market as well. So I think that messaging hurdle, the marketing distribution hurdle is equally big. Maybe they will do better than potentially a brand new from scratch US based ETF shop because they already come with so much scale, but they're also learning a new market. So, is it going to be easy? Probably not. But I would think that that kind of legacy would be a helper, not a deterrent.
Well, and maybe they can bring some differentiation too, just in the approach. Maybe they're doing things a little bit different than have traditionally been done with some of the strategies here in the U.S. And maybe that'll be an angle. Okay, just a couple of minutes left. This segment would not be complete without me bringing up at least one crypto ETF. And we're going to have a lot more to talk about in the coming weeks. We actually had 3 spot crypto ETFs launched today. But the one that I picked out was from CoinShare. So they recently launched an altcoins ETF. The ticker's DIME, DIME. This offers exposure to 10 different crypto assets beyond Bitcoin and Ether. So we're talking digital assets like Solana, Polkadot, Cardano, Avalanche. There are others. And the way that this ETF is getting exposure is by investing in other ETFs listed in markets such as Canada and Europe. And then the holdings are equally weighted. Now, we have seen some other spot crypto index-based ETFs launch, like I think of the Grayscale CoinDesk Crypto 5 ETF. And as I was just alluding to, I think we're going to see a lot more here. But do you think this CoinShares ETF can find a place, or do you think investors will simply wait for the quote unquote direct spot ETFs to come to market?
I think it could definitely find a place. It could be a little bit ahead of the curve here because I'm not sure if you think about this from the advisor perspective. I'm not sure advisors are ready for this. In the conversations we've been having, the good news is most advisors are telling us that because of the more regulatory clarity, the robustness in that framework, they're feeling way more comfortable in going into the crypto space. Clients are definitely demanding it. So this is where this market is going. This makes sense from that perspective because if you think about the challenge that it was to understand Bitcoin, and then we added Ethereum, advisors are already like, whoa, 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 wait, it took me 10 years to get comfortable with Bitcoin. Now you're already throwing at me Ethereum ETFs, and now we already have all these altcoins. It's just, I love the concept of the plug and play for an advisor. It makes this simple. You can get that exposure without having to go become an expert in every single one and what they're offering. I don't know that the advisory channel is there yet, but if it's not there yet, then great. The products are going to be there already. First mover advantages, all that good stuff in play here. I think, to your point, I think the crypto space has been fascinating. This is one example of just these multi-token ETFs coming to market that I think are really interesting, and the different approaches to really diversify that digital asset exposure beyond Bitcoin. So I think this is a cool product in a group of products that are really moving that needle as advisors kind of grow warmer towards them.
Yeah, and I should be clear, as spot crypto ETFs, additional spot crypto ETFs roll out here in the US, this ETF could hold those as well. And so I think what is interesting, and I won't get into the weeds now, there are some differences between this fund of fund structure, right? This is an ETF holding other ETFs. So there are going to be some differences underneath the hood versus a trust structure that holds a basket of spot crypto directly. So that'll be something investors have to consider as well. But Cinthia, fun chat this week. Again, I always love covering new launches. So glad we could do that. And thank you for joining me.
No, thanks for having me. Always a pleasure, Nate.
That was Cinthia Murphy, investment strategist at VettaFi.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR. Looking for a new approach to managing market swings? Webb's Defined Volatility ETFs seek to use a transparent, rules-based strategy that dynamically adjusts exposure to equities based on real-time market volatility. The goal to help maintain a specific level of risk while seeking to enhance risk-adjusted returns. Investing involves risk, including the possible loss of principal. Carefully consider the investment objectives, risks, charges, and expenses before investing. To obtain a prospectus containing this and other important information, please visit https://www.websinv.com. Read it carefully before investing. Distributor Foreside Fund Services, LLC.
I'm now joined by Aniket Ullal, head of ETF Research and Analytics at CFRA, who's one of the world's leading independent investment research firms. And I always say Aniket is simply one of the best in the business covering the ETF space. I would say especially so when it comes to really drilling down into the drivers behind ETF flows and performance. And we're going to focus on both of those areas this week. I would say especially performance. Aniket is joining me from Las Vegas. Aniket, so great having you back on the podcast. How have you been?
Great, Nate. Thanks for having me back and looking forward to our discussion.
Yeah, this should be fun. So we are going to look at some ETF trades that have and have not worked in 2025. And then if we have a few minutes left at the end, I do want to have you look ahead just a little bit as well. But let's start with trades that have worked so far this year. You gave me several categories to walk through. And so I'm going to tee these up and we'll go through them, see how this goes. But the first one you offered up is the dollar diversification trade. And so again, let's jump right in. Explain this for us.
Sure. So, ETFs that track asset classes that investors consider to be store of values have done really well this year, right? So the most well-known store of value, of course, is gold. It's been an established asset class as a store of value for many years, millennia. And so GLD is up, more than 50% this year. We have seen some corrections, of course, in the last couple of weeks, but it's still been a very good year for gold. Gold ETFs in the US have taken in, something like $43 billion this year. And the other newer asset class is, of course, Bitcoin, newer relative to gold. Bitcoin is up about 18%, so not as much as gold. But again, some investors consider that a store of value. And that's taken in about 45 billion. So both gold and Bitcoin specifically have had a very good year. I do want to add a couple of caveats here. The first is that I called it the dollar diversification trade and not the dollar debasement trade. I know there's been a lot of talk in the media about, and by some analysts, about interest in gold and Bitcoin as a hedge against dollar weakness. I think that's part of the explanation for why gold and Bitcoin have done well, but I don't think it's the entire explanation. For example, if you look at gold, its central bank demand is really what's driven gold ETFs this year. If you look at gold, let's say the demand for gold 15 years ago, so 2010, central banks made up only 2% of all demand for gold. If fast forward now to this first half of this year, it's up to 17%. So there are clearly secular factors driving gold demand. And I would say it's important to look at dollar diversification as one explanation for gold and Bitcoin interest, but it's not the only explanation.
Yeah, it's interesting. A few weeks ago, I had State Street's global head of gold strategy on the podcast, and they were just talking about some of the different factors driving gold. And they brought up the significant retail demand as well, particularly from China. So to your point, there are some other factors here that are driving the price of gold, and I would say Bitcoin too. So let me ask you two follow-ups here. Let's start on the gold side. And as you mentioned, physical gold ETFs, I've seen, you mentioned $43 billion or so in inflows this year. And as you know, that smashes the record set back in 2020. It's completely obliterated that record. Interestingly, though, if you look, over half of those inflows have come in just the past 3 months. And so my question for you is, does that point to performance chasing, or does that give you optimism on the price of gold moving forward? Does that show that maybe the dollar diversification trade is here to stay? Is it both? Like, how do you read that from an ETF analyst perspective?
Yeah, I think there's absolutely some element of performance chasing, but it's not the only element of demand for gold. So the way we like to look at it is to look at the fundamental drivers of gold demand beyond just ETFs, right? Just gold overall. And the World Gold Council published some really interesting data around this. And there's really three big buckets of demand for gold. One is jewelry, right? Using gold for things like pendants and necklaces. That generally tends to be actually the largest component and actually fairly stable in terms of volume. So let's ignore that for a second. The two things that have really changed in the last 15 years, one is, like I said, central bank demand that's gone from about 2% to 17%. Now that's a secular, trend. We've seen central banks buying over 1,000 tons of gold every year for the last 5 years. Our analysts who cover the gold sector gold segment and gold miners don't expect that to reduce. So that's going to provide some long-term demand for gold. The third component is investment interest, and that tends to be fluctuate a lot more than the other two components. So this year, investments as a percentage of total aggregate gold demand is about 43%, which is much higher than the long-term average. So I think that supports your argument that yes, there is a performance chasing going on. And of course, we know in the ETF space, flows tend to lag performance. We had very good gold performance last year with not a lot of inflows. So the flows are now kind of catching up to that performance. So I know that's a long answer, but I think basically what's happening is there are secular demand forces from central banks that will support gold demand, but there is an element of performance chasing also on top of that.
I think that's really well said. And to one of the points you made there was sort of this catch up trade. I've talked about that for a while because gold, if you look back over the past several years, has performed extremely well. But we didn't see the flows coming in on the ETF side, which was odd because, as you said, you typically see flows follow performance. We didn't see that. And so now it does feel like there is this catch-up trade. And I think you still have a lot of investors that are just now allocating here. So it does feel like there's some momentum. Real quick, because I want to get to some of the other ETF trades that haven't worked. Bitcoin ETFs, I don't want to spend too much time here because I think I talk about this way too much. But Bitcoin ETFs have seen about $27 billion in inflows this year. And the iShares Bitcoin ETF, IBIT, that's sixth in ETF inflows overall. That's out of some 4,600 ETFs. Interestingly, by the way, GLD, the Spider Gold Shares, that's seventh, even though gold ETFs have taken it more as a category. But given that you mentioned Bitcoin ETFs in the context of the dollar diversification trade, is that how you would characterize Bitcoin as a dollar diversifier? Because some people would argue that this is, still more of a pure risk-on asset. So I'm just curious, how does CFRA view that?
Actually, that's a really nice way to frame it. Is this really a kind of a store of value play, or is it more of a risk-on play? I think what's interesting about Bitcoin is it's a bit of both, which I think is very unusual. It seems counterintuitive because an asset can't be both, right? During times of market stress, a store of value should keep its value, whereas a risk-on asset will probably fluctuate, maybe decline during periods of market stress and rebound when there's optimism. But I think the reason Bitcoin is able to do a bit of both right now is because it's still a young asset, right? It's still a relatively new asset class. We know that some people buy Bitcoin because of the scarcity and the fact that it can be a hedge against the dollar. So that store of value argument still holds for Bitcoin. But if you actually look at the behavior of Bitcoin in the last year and a half, it's behaved much more like a risk-on asset, right? In 2022, when we saw equities and bonds decline, Bitcoin was down 60%. This year, when we had the tariff tantrum and we saw again equities and the dollar decline, Bitcoin was down, and in fact rebounded on the exact same day as other risk-on assets like small caps and large cap equities. So I think there is a store of value element to the demand, but the overall behavior right now is more like a risk-on asset. And I think as the asset class matures, we're going to see which direction it kind of goes in.
Again, I think that's extremely well said. I love the way our friend Bloomberg's Eric Balchunas always characterizes Bitcoin, which is it's gold, but as a teenager, right? And I think with the way that you just described everything, that's perfect because My belief is that ultimately Bitcoin on a longer term time horizon will look much more like gold in the way that it reacts. But it is still young. It's a little volatile, like a teenager. You don't always know what you're going to get. Can be a little moody. So sometimes it shows that risk on, those risk on characteristics. So I think that's really well said. Okay, another ETF trade that you highlighted for 2025, and again, this is a trade that's worked, is the ex-US equity trade, which I'll tell you, Aniket, I think a lot of diversified investors are like, finally, international is working. It's not just dead weight in a portfolio. So talk about this. What stands out to you on this one?
Well, there's a couple of things that stand out. One is Europe has actually been, after a long time, a surprisingly good market. I think in local currency terms, it's about been equivalent to the US, which has historically lagged the US in local currency terms. And if you're an investor in the US, sitting on US denominated assets, you're also, benefiting from the dollar depreciation. So it's European exposure has been good for US investors, particularly in a few segments. One is financials. EUFN, which is the Europe Financials ETF, has done extremely well this year. I think more than 50% returns again in USD terms. Europe, we should emphasize, is a very financial and industrials heavy market. I think typically, depending on the choice of index, financials and industrials account for about 40 to 45% of European exposure. And those have been strong sectors in Europe this year. So that's why Europe has done well. It's a nice complement to the US. In the US, technology is almost 30% of the index. In Europe, it's typically less than 10%. So in that sense, you're getting kind of different exposure with Europe, and particularly Europe financials and industrials have been strong this year.
Let me ask you this. We were just talking about the dollar diversification trade. How related do you think that is to the ex-US equity trade? Because I think clearly there's some relation here, but you have these as separate trades. So maybe talk about that a little bit more.
Yeah, maybe a couple of important things to touch on. One is there's been interesting research put out for the Bank of International Settlements, BIS, which basically shows that the dollar weakness this year was primarily caused by institutional investors abroad hedging their dollar exposure. So in April, there were a lot of institutional investors in Asia, particularly, who were sitting on huge dollar exposures, US equity exposures that were unhedged. And after we saw the downturn when tariffs first came out, a lot of them exposed, kind of added on hedging, hedging to hedge their dollar exposure, and that caused dollar weakness. So in other words, it's not like investors don't want to be invested in US assets, right? They still want to be invested in US equities. You're not going to get the Apples and the Metas and the Alphabets in any other market, but they're layering on FX kind of strategies on top, or hedging strategies on top of that, which is causing dollar weakness. So that's the first point. The second is, if you're getting exposure outside the US, you're holding non-US assets, but as a US investor, then you're really two components to look at. One is the currency conversion effect, and second, what's happening in those local markets. So if the dollar gets weak, you do benefit from currency conversion because you're investing in US dollars. That gets weaker. When you convert back to US dollars, you benefit. And the second question is, how does a weaker dollar affect the local currency returns? That depends on each individual market, right? The markets like Argentina and so on, where debt is denominated in USD, maybe they benefit from a weaker dollar, whereas other markets like China and Vietnam that are more export oriented prefer a stronger dollar because then their own currency kind of gets weaker. So there's really two components to look at. One is currency conversion, and second is local currency returns.
Okay, let's highlight one more ETF trade that has worked in 2025, and that's what you're calling the one big beautiful bill trade. Of course, referring to President Trump's sweeping tax and spending bill that was signed into law back in July. Talk about the ETF categories impacted here.
Sure. We talk a lot, Nate, about tariffs and so much media attention to tariffs, but I think the one beautiful bill flew under the radar a little bit, and I think it's had very significant implications for ETF investors. One sector that's been impacted is defense. There was 150 billion allocated for defense above the standard spending that happens annually, and that's really benefiting defense ETFs. And I would say that another sector is telecom. We've seen this year that a return to 100% bonus depreciation on capital assets. So that really benefits ETFs, stocks that have big capital investments. So telecom is clearly one. So telecom, for example, if you look at AT&T, they had almost $6 to $8 billion in annual tax cash savings this year because of this change. So there are structural changes that affect these stocks and that benefit ETFs. So I'd say telecom and defense have clearly been beneficiaries of the one big beautiful bill.
I love the defense ETFs coming up here because interestingly, if you combine the ex-US trade and the one big beautiful bill trade, there are some global defense ETFs that are near the top of the ETF performance leaderboard if you go and look at it. So I ran this morning. You have ETFs like the Select Stocks Europe Aerospace and Defense ETF, ticker EUAD. That's been near the top of the leaderboard all year long. You have the Global X Defense Tech ETF, ticker SHLD, like Shield. And then you have the Themes Transatlantic Defense ETF, ticker NATO. A couple of great ticker symbols there. But I feel like that's been sort of an under the radar ETF story this year. Have you looked into that at all much, just the global defense ETFs?
Absolutely. I mean, I think each of these ETFs is up about, depending on each ETF, but in the range of about 80 to 85% this year in USD terms. I think this is a good example that ties back to your previous point, which is investors are benefiting from the local currency returns. And then on top of that, you have currency translation effects. So, there's been a double kind of benefit here. I don't think the local currency returns are driven by the US dollar. I think that's driven more by geopolitical factors, right? The fact that the US may pull back a little bit from NATO and require more spending from countries like Germany on defense. So it's really a combination of strong local currency returns with this other additional currency translation benefit.
Okay, let's now move over and talk about a couple of ETF trades that have not worked this year. And the first one you flagged is the healthcare trade, which, it seems like healthcare has been underperforming for several years now. It's been a tough sector to be in. What's been going on in this space?
Well, the impact this year has really been, again, the budget bill. One of the big things that happened in the budget bill is they needed to find money somewhere. And where they found money was in Medicaid reform. And so they added a lot of things to Medicaid, including work requirements and so on. And so that's going to result, our analysts think, in a reduction in covered lives. It's going to put a lot more pressure on rural hospitals. And so if you look at the managed care component of healthcare, that's really been under pressure. So, ETFs that focus on that hold, stocks like United Healthcare, Molina, Centene, these are companies that have big exposure to manage, Medicaid. And so these kind of Medicaid, NCO type companies are going to be under pressure. That's been one of the things weighing down the sector. Having said that, CFRA recently upgraded healthcare from underweight to market weight. And that's more driven by pharmaceuticals and biotechnology. And the view of our analysts is that this sector is getting the sentiment is becoming a little bit more positive. We saw Pfizer enter into an agreement with the US government recently on most favored nation drug pricing, which kind of takes away some of the uncertainties around tariffs. So we've become a little bit more bullish on the healthcare sector, but primarily due to pharma and biotech rather than managed healthcare.
I don't want to get sidetracked here, and I can't remember if you and I have talked about this before, but do you have any strong views on how investors should approach traditional sector ETFs? Like, do you see these as tactical trades, or are these a way to balance out or round out a portfolio if maybe the composition of core holdings is out of whack? How do you see investors using these?
I think it really depends how investors construct the core of their portfolio. I mean, if investors are using, IVB or an S&P 500, other S&P 500 ETF or a Russell 1000 ETF, then sector ETFs probably become more of a tactical overlay on top of their core holdings, because otherwise you have duplication. For those ETFs for those investors rather, who take a more disaggregated approach, where they don't hold the entire S&P 500, but they use sectors to get that core allocation, then of course sectors becomes a more core holding. So it really depends on how investors view it. There's also other ways to do this, like investors have looked at QQQ as a way to get more of a technology tilt or a kind of Mag 7 tilt. So it really depends on each investor's kind of individual approach to construction.
Okay, one other trade that has not worked in 2025, you have commodities. Specifically, I would say energy. And if you look at the underperforming ETFs this year, there are all sorts of commodity related products that have underperformed. I would say from energy to agriculture. It's really like if you take out metals, especially precious metals, it's been tough sledding for commodity ETFs. So talk more about that.
Yeah, energy certainly been a sector under pressure. If you look at the forecast for crude oil next year, it's actually not that great. The outlook is fairly bearish. Although our analysts think that maybe the EIA's outlook is too bearish, but nevertheless it's not that positive. So I think this is a sector that may continue to be under some pressure. So energy, like you said, energy, healthcare, some of these sectors have underperformed relative to the market.
Are you surprised that we haven't seen maybe some better performance in the energy space in particular? Because I think of, say, the AI trade, and we know about the AI data centers and the growing need for energy. I mean, that's a really big story, and you might think that maybe that would help boost that sector a little bit. Any thoughts on that?
That's actually a really great point. In fact, I was just discussing this with our energy analyst recently, which is why is it that the AI trade hasn't helped energy stocks more? He had a couple of insights which I think are useful. One is that the build out of data centers actually takes time. So yes, there is AI demand and there is data center demand, but that build out does take time. And so I think there's going to be a bit of a lag effect in terms of data center demand on energy. And the second is that, it's not all segments of the energy market serve the data center requirement. It's really more natural gas that's going to be used for that sector rather than liquid, right? People producing crude oil. So the Exxon Mobils and those kind of companies are not really going to benefit so much from the data center demand. It's going to be more stocks that are natural gas focused. And there's actually been an oversupply of glut of natural gas recently compared to long-term averages. So, as the data center demand picks up and we then that results in natural gas demand over time, I think we will see effects over time, but it's going to take a little bit of time for that
No, that's
to
a
happen.
great point. And I think that ties into the nuclear energy story as well, right? Which we've seen some tailwind on that story. If you look at uranium related stocks and nuclear related stocks, I think there's some thought that maybe that can be a solution here as well. Aniket, just a few minutes left. If we look ahead to the remainder of 2025 and perhaps into early 2026, is there an ETF category or two that has your attention right now that we have not covered this week that's on your radar? It can either be a trade that might or might not work. And to be clear, I'm not asking you to get out your crystal ball and tell us what might outperform or underperform, but maybe just a category or two that has your attention that investors might watch a bit more closely.
Well, perhaps this is an obvious statement, but I think the thing we're watching more closely right now is the government shutdown because we have a policy group within CFRA that watches this, and I think that's an important thing to track because obviously the shutdown, the most immediate impact is on the DC economy, but if this thing goes on for longer, the question is does it result in a recession and then affects of course many ETF categories. So that's I would say the biggest macro thing to follow. The other thing we're looking at is small caps. Assuming the shutdown doesn't go on for too long, we've actually seen small caps outperform large caps in the last 3 months. As you know, Nate, we've been in a very top-heavy Mag 7 driven market for so long. But those stocks are really priced for perfection. Whereas if you look at small caps, they're trading at a discount to their long-term P ratios. So I think small caps is a sector we want to keep watching, particularly small cap industrial, small cap healthcare. So I think I'd keep an eye on those sectors.
I like it. Small caps is a good one. I think like international equities, which we talked about earlier, there are a lot of investors that would like to see some sustained outperformance from small caps. And they've had, to your point, you look back over the past 3 months or so, performed very well. I think investors would just like to see a much longer period of outperformance. But Aniket, I always enjoy connecting. Great stuff this week. Thank you so much for joining me.
Thanks, Nate. Thanks for having me on.
That was Aniket Ullal, head of ETF Research and Analytics at CFRA. That'll do it for this week's ETF Prime. I'm excited to tell you that I will be at Exchange 2026, where I will be taking the stage and even recording a live episode of this podcast. So this is your chance to join me alongside a community of top advisors and industry experts for a few days of world-class content and unparalleled networking. You can secure your spot today by visiting exchangeetf.com. Next week, I will be joined by the ETF maestro, Eric Balchunas, senior ETF analyst at Bloomberg. And because I've learned from our past conversations, I'm going to give Eric the full hour on this podcast, which means we will go all around the world of ETFs. You certainly won't want to miss that. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities. And anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.